met my great grandmother. But I met my great grandmother, Bertie, and because I was like 3 or 4 years old when he passed. So in 1966. And so I didn't really get to know him, but I knew my grandma Bertie, which is my great grandmother, but also they had 12 kids. Back then it wasn't a big deal to have 12 kids, but we had 12 kids. And if you're a man, you're in the oil business. And if you're a woman, you're married to somebody in the oil business. That's just how it was. And out of all my great uncles, I had two of them that started their own businesses and in the oil business, but everybody else was service working for other people in the oil business. So not a lot of entrepreneurs, but we'd go to family reunions, in Lake Brownwood, because everybody was kind of in between East Texas and West Texas, and Lake Brownwood was pretty close to the same. And there'd be hundreds of people, and all we talk about is the oil business. I mean, it really was kind of, I don't know, just that's what we did, right? We talked about, hey, what are you drilling? What's going on? What wells are you completing? Who are you working for now? Who's the hot people in the world? Who's buying who? What acquisitions are going on? And just the whole idea and the whole persona, if you will, of what it's like in the old business. We obviously did that. And my grandfather, who I grew up with, I spent a lot of time in his pickup. He had a three-speed on the column pickup, and he let me drive his pickup if I went to the oil field with him.
Three on the tree.
Three on the tree, exactly. Three on the tree.
F100, I imagine, back in
that day. Yeah. And but great truck, and we'd go down and we'd go down and I remember putting acid in wells. I remember, all the tanks, and he'd go up on the tanks, and I'd measure tanks, because every day you have to walk up on the tank and put your measuring stick in there or tape, and you would run it down the bottom of the tank, and you'd see, okay, well, hey, today's at 19 feet, and yesterday was at 16 feet, and that's 3 feet it made of oil in the last 24 hours. You'd measure that tank every day at the same exact time. 365 days a year, literally. I mean, that's what. Wow. And then, it's like 1.67 barrels is an inch. So I'd go home, and my grandfather, I'm not sure how much schooling he got, but not very much. But I'd fill out all the tickets, and I'd do the math at the end of that's why I love math. I'd do the math at the end of the week on how many inches the wells did and how much oil that was and how much oil was in the tanks. At the end of the week, what did we start off with? How much did it produce? How much was sold? And how much is left at the end? So we did all that math, and it was pretty neat. And but anyway.
So Jay, that's awesome. So you went to college, you spent some time, graduated from college, had some, man, if we had time for your college stories, which we don't, maybe another time, but those are some good stories. But you bounced around a little bit through some different things and spent a little bit of time, 3 or so years as a broker, but then you came back to the oil business. You even did some oil business, I think, work in that transitional time, but then you came back and started an oil business with Michelle, your wife. So what was that like, especially in the beginning? Like I'm just trying to grasp a picture of you starting an oil business with your wife. What was that like?
Yeah, well, it is what it is. I mean, she's a great person, and she does a lot for our business. It still does, and great having her here. To tell you something about her and her character. I mean, her water broke, and after her water broke, she was yelling, or not yelling, but just how women do, and she was like, I was driving to the hospital, and she said, no, we got to go by the office first. And I said, the office? What do we go to the office for? She goes, well, I know that payroll's finished. I've got a little bit of time, and I need to go by and sign payroll before, because if not, they're going to come up here tomorrow. They won't have payroll. And it's just the kind of person she was. I mean, and then she'd bring the carrier in to the office and, work from here. And, and at that time we were doing smaller deals, and it wasn't very I don't know, the profitability and the wells that we drilled just weren't there until we changed our model up, a little bit later. But in the beginning, man, it was tough. It was tough.
Well, I know, and it's an awesome story. I remember Michelle talking about, and you talked about bringing Michaela and your daughter on in the carrier, but I know she used to talk about how she'd come in, and I mean her office was, the desk there and the playpen was right across the way, and I mean Michaela was part of the business even when she didn't know it. So
yeah,
I always enjoyed her telling stories about wrangling Michaela when she was trying to run the office. So well, and to your point, you brought this up, and I think this was really good. A good segue was, you guys, this is back in 1995, 96. And so you spent a number of years working in the business, drilling wells, raising money, drilling wells. And you came to an inflection point around 2015 and, had some, I would say, obviously had success, but had some frustrations too, generally with the model. And the way you described it is, or at least the way I received it when you told me the story it was frustrating because there was just something missing. It was like there wasn't enough opportunity or value. And so you kind of came to this, I call it an inflection point. And you talk about the story of David Moore and you guys are friends and you guys are on vacation together. And there's obviously frustration in your heart about this, but you're a consummate learner, which is one of the things I find really fascinating for me, just working with you. But you're trying to figure out what's wrong with the model, and you're talking to David. And so you guys are on a chairlift. So tell us about the chairlift story and what you learned.
Well, so David's probably 15 years younger than I am, and having a tremendous amount of success. I mean, a tremendous amount of success. And I'm talking to him, and I can see, I can see how successful he was talking about, how many apartments they were managing and the sales and blah, 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 all the different things. And I said, man, how's business? And he said, man, Jay, it's unbelievable, right? I mean, 2009, everybody sells their homes, goes right into apartments. I mean, no brainer. The apartment business is going to kill it. And I've always learned, hey, try to ask the best questions that you can. Ask the best quality questions. So I asked him a question. I said, hey, so how do you structure your deals? And he said, it's a good question. He said, we're on a chairlift, Beaver Creek, going up the mountain. And I said, how do you structure your deals? And he said, well, we do the value add. And I said, well, I don't understand what's value add. He said, we'll find an apartment complex that's got a great address, but it's a little rundown. And he said, we'll buy it, raise some money to value add or, paint the roof or paint the swimming pool or, redo some of the apartments or something. We'll raise the rents and then we'll either sell it or we'll refinance it and manage the property. And I go, wow, that sounds pretty good. So I thought, okay, so how do I do that? So I got home and my guys, sometimes when I go to these seminars, they didn't like the day after because I'd come in and, oh my gosh, here it is, the best, best sausage making machine ever, whatever. And I said, hey guys, let's talk about this. I think there's a way we can do this. So we came up with a way in 2015 to purchase an asset, increase the value, and then sell after like 15 months after the first check came in. We sold that asset or sold a third of the asset for 131% return back to clients. They still own the other 2/3. So we did that very successfully. And man, that's what we just kept on doing. That's what we did. We're going to do in Fund One. But it was kind of an eye-opening experience that it was good for us as a company because I'm in the oil business, right? I mean, we go out and drill wells and we have that, and we stay out there, and I've spent so many nights at an oil rig and my grandfather, and talk about my book in a minute, but tell us some great stories in there about my grandfather. And, he couldn't sleep if he went in town and got away from the oil field because there weren't any pumping units go up and down. And people that came out to stay with him couldn't sleep because the pumping units were so dang loud. He'd go in town, he couldn't sleep because there wasn't any pumping units, making tons of racket, so, but anyway, good story, good stories and a great learning experience for me on how to change that model, because I know a lot of people here on this call probably know everything there is to know about value add. And I didn't. And I didn't. The oil and gas business was not built like that.
Yeah.
It was built differently. And so that's all we did was doing the same thing over and over again, which was kind of frustrating because we would drill wells and then have to go raise money to go drill more wells. And then there wasn't an exit. So what I learned was there's multiple income, there's tax benefits, and there's also a place where we can have a good exit down the road where we can have a multiple on invested capital.
Hey, so Jay, and you'd mentioned your book, and I wanted to throw that out. I mean, one of the things I loved about that chairlift story, which is actually in this book, and it's the upside of oil and gas investing. So it was sort of a labor of love the way you described it, but it says how the new model works and why it puts the traditional model to shame. So you can actually pick this book up, folks, on the webinar at kingoperating.com/learn. There's a free PDF of it. So if you want to pick it up there, again, kingoperating.com/learn. You can go on Amazon and buy it hard copy if you want. You could also get the Kindle version. So, and interestingly enough, Jay is in the beginning stages of narrating the audio version. So if you're an audio fan, that's coming out in the first quarter. And Jay, I mean, you can hear Jay's voice. He's got a voice for radio. So I'm actually excited to hear the audiobook version of that. And again, it's the upside of oil and gas investing. And it's a great read. I've read it. Honestly, I mean, I knew Jay, we were friends, but the book was inspiring to me because it was different, and it's not complex. It's actually, and doing it's a different story, and we're going to talk about the details of that here in a second. But Jay, I just wanted to say thanks for joining us and getting us started today, and we're going to go ahead and transition now into the topic that everybody came to hear today, which is if you hate paying taxes, pay yourself instead. And we're going to get to that. And that's where we're going next. And Jay, I know that was one of the big hooks that led you to want to value this, because the one thing that, briefly, if you could just close on this one question, Jay, how would you describe the difference between getting a tax break from oil and gas versus real estate? Because we got a lot of people who probably are on this call who understand real estate, but specifically, very simply, what's the difference between those tax breaks?
Yeah, substantial with oil and gas compared to depreciation on real estate. So big difference there. A lot better for oil and gas. It's not 27 years, whatever, and you get to write it off 100%, and you get to write it off probably about 85% the first year, if not more than that. But so you write it off the first year. So you get to advance, take it all the first year. I mean, it's like, you don't have to wait around for it for a long time. And yes, oil and gas is riskier than real estate, but it's also a risk reward model that we've gone and forth and mitigated the risk, which I know Peter will talk about in a minute, but I think that's about it. We get to write off, and good chance there's a chance we can write off 100% this year. I know we could a couple of years ago. I don't know if Joe Biden will do that or not. He should have that write-off capability for all the investors, and so maybe some of these public companies would start drilling again instead of keeping the money in the bank or buying back their stock, which that's a different topic. But
I'm okay that they're not. But hey, Jay, thanks for answering that, and we'll get into more details here in a second. But Jay Young, everybody, definitely check out the book. And let's go ahead and get into the presentation. So let's see here.
I'm gonna sign off.
Yeah.
But I'll be on, right?
Yeah. Thanks, Jay.
All right.
Thank
You're
you.
welcome. Thank you.
Let's share. I'm going to share screen here, gang. So, all right. So, hate paying taxes, pay yourself instead. So we're actually going to get into the how of that. So, let's, we covered that already. Again, kingoperating.com/learn for the book. You know, we got to do this. It's the disclosure. You guys see it up here, but bottom line is it's real important to know that this is information that is designed for your consumption. It is not a promise or a guarantee. So this is a plan. It's information that we use best efforts to understand how to make sure that we can provide information for you to make an informed decision. But again, it represents in no way a promise or guarantee of results. So investing in oil and gas is risky, and you need to invest at your own risk. And if you need help from a financial professional or a tax professional, you need to seek that advice from them. So, all right, we'll get that out of the way. So what are we going to cover? Well, very simply, three things. We're going to talk about the strategy. We're going to talk about the value that you can achieve. And then we're going to talk about the track record that is behind this actual model. So first of all, what you guys can see on here is the plan. The plan is to increase the value of an asset to over $1 billion. This is a drilling program. So we're raising $200 million to actually acquire and develop and then divest assets to deliver a multiple. So there's three parts of value. We'll get into that, and let's jump into what is the strategy. So the first part is on the left. So you see it on the top. Let me go first on the top here. Scale it and sell it for a multiple. Okay, that's the simple version of the strategy. On the left-hand side, the most important thing is what do you get out of that? Okay, so what are you getting out of this strategy? Well, first, it's to reduce your tax liability significantly. Also, to achieve the delivery of monthly passive income. And then, of course, as Jay mentioned earlier, that ROI multiple on exit. And the way that's accomplished in this ADD model, this value add that he learned on the chairlift and began applying to King Operating and investors here is to acquire and develop and divest. There's a whole path to how we actually do this, how it gets done. That's to mitigate risk and also to achieve that maximum value. And so it's very important in oil and gas to mitigate risk. We'll talk about how that works a little bit more here as we go along. So what's that look like at the next level down as we kind of drill into this? First, you've got to acquire leases. Then you've got to raise equity. And you do that. There's an overlapping model you can see here inside this strategy. Obviously, get to drilling as quickly as you can. We'll continue to raise while we're drilling. We'll even continue to acquire leases. There's a staged approach to the acquisition that we do that helps manage the leverage that we can achieve with the leases, and being able to do that by maximizing the minimum spent capital on those acquisitions. We continue to raise equity, as we talked about. We drill that new PDP. We produce revenue off of that, right? And so investors are going to participate in this. And then we prove up those PUD locations. PUDs are proven undeveloped. It's locations that occur after drilling what we call PDP wells, which we talked about. What is PDP well? Well, it's approved, developed, producing well. It's basically producing well. And so PDP and PUDs, they together produce value at scale. And the only way to get to a multiple on exit is first you have to have value at scale. And that's what drilling a lot of wells in different locations will open up the opportunity for us to do. And so there's a lot more detail we'll be able to cover on that, but let's keep drilling in. So it's a little bit of an eye chart. Sorry about that. I know we're on a webinar and trying to listen and read at the same time, but stay on the top, stay with me. What's the acquisition methodology? Well, first it's to source, then to qualify, then we got to prioritize, right? And this is something that occurs over time. We start with some attributes in the sourcing, And we want to start with basins of focus, right? So we have specific areas where we have relationships already in play. So we'll look at what those are, what those basins of focus are, but we already have relations in play. We already have disciplines in that area, meaning we know how to do it in that area. Just because you know how to drill a well doesn't mean you know how to drill a well. Let's say, for example, in East Texas, doesn't mean it's not the same drilling a well necessarily in East Texas as it is in the Bighorn Basin up in Wyoming. Just weather alone makes change in how you actually accomplish drilling. And so having people on the ground there, people that are actually that know the area, that know the geography and the geology is important. But we go through these attributes within particular fields that make sense. And we'll talk about what that looks like here in a second. But these attributes within these fields, within these basins of focus are really important. So you can kind of see this, you see how this this scales into itself. I don't know, you call it, what are those little Russian thumbnail deals? One comes on top of the other. I don't know. I'm not sure if that's playing for anybody out there, but anyway, these are all interconnected things. So from a basin of focus where we have people on the ground and we have experience, assets, the fields themselves, what do those assets look like? Well, they're underdeveloped. So what that means is there's probable, in the oil business, we talk about probable. Probable is there's adjacent or analogous, as our buddy Rex in the business likes to talk about, analogous wells that have already been proven up. So it's just underdeveloped. So you have a field that's within scope of other fields nearby that have proven zones. Another thing that we look for is attractive pay zone geology. So we like to see data, preferably 3D seismic. We have that help us understand what's going on under the ground by using something kind of similar to like bat sonar to determine what kind of hot spots you can get under the ground. Drilling locations, making sure that, look, if you're going to prove up a field, you've got to be able to have locations in the area that you're drilling so that that extended value or that multiplier can be achieved. And so not only do you want to have places where you can drill, but you need to have places that provide opportunity for growth in future drilling. That drives value up. Obviously, you want an oil and gas friendly community. You want to be in privately owned. A lot of people ask, well, what about federal, regulations? We primarily drill in privately owned or state owned acreage. And then here's a really important part: low cost. Hear me on this: low cost, high control leasing terms. What does that mean? Well, when you're looking for underdeveloped fields or acreage, what you're trying to do is make sure that you can expend as little capital in cash up front for maximum leverage or control as you develop up the field. What it does is it gives you the ability to come in and control the drilling and control the terms before drilling for expanding into the field as you prove it up. So as you prove it up, you're basically buying it at its value in present time. Well, the value of that acreage is going to go up if you prove it up. And so by creating this leveraged high control leasing terms on the front end, we protect the lower cost so that as we expand, we can get extended value out of that without having to pay the premium. Because we want to turn that premium into dollars for you guys, for us. As investors, we're investors too. I'm a partner, not just somebody who's drilling, and so is Jay. Jay's the single largest investor in our funds, and so it's important for us as investors to be able to have that kind of leverage in the way we make acquisitions on leases. And then, if available, PDP is another thing. And I know I'm camping on this. This is such an important part of the strategy: is making sure you get the acquisition right, that you get as much value on the front end as possible, and that you stage that. That's the other part that's really important. And I don't know that this slide really shows it, but to be able to stage your value across a timeline where you have the leverage, you're able to prove it up. What it does is it mitigates risk in case something goes wrong. If everything we see says that things are going to go right, but we have a bad well or a dry hole, which we've only had one in recent memory among more than 40 wells drilled, which is an incredible success rate. But when you look at how you're able to leverage that and protect investors' capital, you're able to say, hey, look, if it didn't work out, we're not like sunk in, all in on one location, right? That's one of the reasons why we look at different geography, not just diversity in the geology, but also diversity in the geography, so that we can mitigate that risk. That's why it's important to have a pipeline of acquisition targets as we drill and as we grow the asset, so that if we need to add or pivot, we can do that because we already have those conversations in place. So another thing that's important is product mix. Look, oil and gas, natural gas, if you look at pricing, they are tethered as commodities, but they're not the same. So you get some diversity, or some mitigation, I should say, in the diversity of your product mix. Very important that that's part of your acquisition methodology. If you start this stuff out wrong and you're not getting your acquisition right, it doesn't matter how hard you work to develop. You're drilling in the wrong place. And I already mentioned the geography footprint. I know I camped on that page, but honestly, sometimes I think that's the most important part of the story. It's really not. There's a lot more. So what else is in the strategy? Well, the development. So let's pay particular attention to the top there. So we obviously have the asset strategy, which is determining, okay, how are we going to, it's specifically operationally, how are we actually going to go after this? How are we going to plan the locations? How are we actually going to execute on the drilling and completion and then operate? So the development is really around making sure that you're setting the stage for the scalable growth. Planning matters. Having the right strategy for the assets that you're acquiring, and then actually going and drilling the right locations to come out of the gate. There's a lot of work. It's a whole nother webinar, right? When you get Paul Jerome, our senior vice president of geoscience, he's this super brilliant rock star, a geologist. He was part of GeoSouthern. He took a few $100 million and turned it into over $1 billion. He's actually already done this, and he's leading our geoscience effort. And so he led a team of folks that did that. And man, we love Paul, and he has an awesome beard, if I could say that. I have a beard, but I love his beard. He's a better beard. He's not on here to it's amazing. Anyway, sidetrack here, but if you see on the bottom there, the near-term development plan, we already have 2 assets live. We're going to take a look at them here in a second. We're already working on drilling the first set of wells in what we call the Believers Project. I just got off a conversation yesterday about some pad work that we're doing. You got to clear a location and get it ready. This is all the prep work. We got a rig coming out really soon. We got a bunch we're drilling 12 other wells in our other fund that is now closed. And there's already revenue producing on that. And we've had our first divestiture, but that's another story. So, and then we're looking in January and February to continue to complete those wells and drill the next set of wells as we're able to obviously raise funds. The important part on here, and I'm going to throw it out now, is because we're talking about taxes. And by the way, you're probably thinking, well, how is this relevant to taxes? We're getting there. You have to understand this part. You got to understand the strategy to understand how the tax benefit works. So hang tight. The tax benefit deadline to get in on this is 12/30. That's Friday, 12/30. So you got to have your wire in by 12/30. That's an important part of this. If you're interested in actually getting involved in this project, if you're not, it's okay. I hope you're learning a lot. So, okay. Third part of the strategy. So we talked about acquisition. We talked about development. We talked about now divestiture. What does divestiture look like? Well, it's sort of the reverse project there. Source, qualify, prioritize, negotiate, and close. There are 2 types of buyers. The goal is to achieve an exit. We want to take all this and get that. And when I say achieve an exit, it's actually, like we talked about earlier, it's to scale it and sell it for a multiple, right? Well, you got to have divestitures to do that. So, well, the only way to have a divestiture, right, is to have buyers. There are 2 types of buyers that we explore on this kind of a deal. One is an income buyer. If the asset gets enough value and enough income produced based on the capital raised and the success of drilling, you can look at income buyers who are institutions, their pensions, family offices, those types of folks who actually want to buy the income. And they want to buy into the strategy of keeping that income going, reinvesting, and then keeping the income producing. The other buyer are other producers. King Operating is considered a small independent operator. And so there are other mid-tier and large public producers that are in fields near and around these areas of focus, are fields that we've selected. And in these basins, like the Permian, for example, or the Bighorn up in Wyoming, or the East Texas Arklatex basin over there in East Texas. So there are producers around these fields that are underdeveloped that would be interested in bolting on to their acreage and blowing things out with what they would consider less risk and more opportunity. So they make great buyers for multiple as well, depending on their strategy. The idea behind it is the sum of the parts is greater than the whole. So turn your attention to the right there. Typically, especially because of the risk mitigation strategy that's deployed, where you have multiple basins of focus in the asset pool, you need multiple divestitures. And the sum of those divestitures is typically more valuable than selling the whole thing at once. Would we sell the whole one? Sure. But the better play is to sell these assets in pieces, because you're going to have different buyers with different areas of focus, and you're going to get a max value on your premium, on your multiple, a max premium on your multiple for that area, because it's focused on that one potential buyer, or that small group of buyers, their own strategy and their own geographic focus. And so adding those parts up, that's what gets you to the ideal exit. So that's the strategy: acquire, develop, divest. Let's talk about more specifically, what is the value in that? What is the value that we can expect as investors, right? Well, first you got to understand what the asset profile looks like. So again, lots of information. Stay to the left over here where all the stuff is, the states and so forth. And you can look at the gold areas. That's the Permian and the Bighorn Basin. Those two areas specifically are the focus right now. We are exploring other assets as part of that acquisition strategy, having conversations. There's a timing aspect to that. Right now, there's not a burning need for us to do something there, but that doesn't mean we're not having the conversations we need to have to keep things warm, depending on what occurs in the Permian and in the Bighorn. These projects up in the Bighorn, that's called the Rhino Project. We already have activity in our other fund going on in this area, and so we have experience. We've actually spudded our first well up there. We're working on a recompletion as well. That's in the other fund. But in the Believers Project down in the Permian, that's an exciting asset as well. And that's the one that we are working on pad construction, where we're actually going to go set up a rig and start drilling this month. So drilling is already, drill planning is already continuing, obviously, and starting to get into execution around those first tranche of wells. We'll be drilling in this fund in the Rhino Project up in Wyoming. We'll be drilling middle of first quarter, so into January, mid-February timeframe. So what does this look like when you look at that footprint on the left? What does it look like from a quantifiable basis? That's the attribute. So take a look on these 5 basins of focus, specifically on the gold. Is the gold pieces is what we're looking at for these data points. The estimated fair market valuation is a little over $1 billion. That is the goal. That's what is a fair market value? It's what somebody's willing to pay. Well, the pieces, remember we talked about the pieces of the divestitures. That's the ultimate goal, is to get a divestiture of all assets equal to $1 billion or more. What's the estimated PDP, or the actually producing wells that we have scoped to drill, which can and most likely will change? That's $840 million. So you see, you get a multiplying effect with what we call those PUDs, right? We saw that in the earlier part of the strategy breakdown as we walked across the map into exit window. So estimated PDP valuation of $840 million. That's obviously above ground, not yet drilled. That's the goal. Acquired acres so far, it's about 36,000. Those 2 fields we talked about. Product mix target 50-50. We have an oil and natural gas play primarily in the Bighorn. We can work with both. The wells that we're targeting there big natural gas opportunity. By the way, as a side note, for all you EV fans out there, just wanted to keep you abreast of the fact that you are also contributing to this play. And the reason why is because, and if you already know the answer, I'm excited for you, but electric utilities, you got to plug those things in. They're battery operated, right? Electric utilities, guess what fuels electric utilities? Natural gas and coal. Natural gas is a huge part of the EV play. So, and there's a huge shortage of it in Europe, and that's creating a huge demand and price. There is a pretty far out horizon for high value in natural gas, and it's been in a long-term lull up until this year. So that's pretty exciting to have a lot of natural gas in this. But again, product mix is important. Total locations 200 plus that are already pre-qualified for drilling. Right now, we have 18 drill-ready locations. And so you can see the rest of the PDP count target that we're setting, somewhere between 18 and 21 wells, depending on how inflation affects drilling costs. And if we're able to, side note, if we're able to keep things focused from a contingency standpoint when we drill, so if we can keep that contingency, what we plan for is 12% contingency, which has been running about where inflation has been in the field and the cost for us to actually go drill wells. But if we can narrow that down to 6%, we put that capital back to work to drill extra wells. And we think that there's a possibility we could actually add maybe 1 or even 2, 3 is a stretch, but it's on the map for an outsider opportunity. So, and then the PUD counts that come as a result of that. This is all important information about the profile of the assets in which generate revenue. They generate those 3 uniquely linked components of value. So lots of disclaimer stuff in here. It's important to know this is not a drill plan, but what I wanted you to see here is there's actually math behind this. So we talked about the assets. Well, how do you actually get to that? Well, first turn your attention to the middle. There's a baseline price here, and that's $80 a barrel and $6 an MCF. We're running in that range right now. Things are up and down. Oil prices they're climbing a lot right now. They took a plummet a couple of weeks ago, but we're expecting them to go back up. They're still high. We still, as an asset, can make exceptional returns in the 70s. Even in the 60s, we can do well. So it's important to know that you've got to set a baseline for your pricing. That's what it is. You can see the wells and how the value is determined. So again, this is not a drill plan. This is a valuation based on the information we have today on the assets that are already acquired. And you can see we have a line item there for a possible third asset acquisition, which could come down the pike. So if you follow left to right, so in Texas, in Borden County, what we call the Believers Project, we're scoping somewhere around 8 wells potentially. The EUR, which is the estimated ultimate recovery. So how many barrels of oil could we get out of the ground in a lifetime? And that's over anywhere from a 20 to upwards of 50-year lifespan of an oil. How much oil could we get out of the ground? Obviously, as much as quickly as possible is the best, but that's almost 600,000 barrels of oil. And the EUR on natural gas for those wells is 342. It's like 3.4 million cubic feet of gas. So the value at those prices is around $49 million per well. These are 2-mile laterals, which means we go down and drill like a shoe almost. You get a heel and then you come across and you drill through the pay zone horizontally, and you do that for 2 miles. So the total value on those wells is approximately, when you add them up, is approximately $400 million. And then you can follow that same math on these Bighorn Basin, that what we call the Rhino Project. You can follow that math as well, which these are nice oil wells at 212,000 barrels, but much bigger play. You're talking about 4 4.5 billion cubic feet of gas, which deliver a PDP value based on these prices around $44 million a well. So we want some balance in there. Again, I can just tell you, if there's anything that's important to note about this is an above ground view based on the assets that we have right now. We like this view. We chose these assets because they're underdeveloped, but we have a lot of proven data to tell us there's a lot of opportunity there. We love underdeveloped stuff. This is where it's at. This is where you create value. You get a PUD multiple. We apply a 1.25 because that's in the marketplace, something that we're seeing right now as far as extending value beyond PDP. That's how you get to $1 billion. Will it turn out that way? That's the goal. We can't guarantee that. We can't promise it. Once you put a bit in the ground and start to turn it right, that's when you're going to know, hey, is it going to be better? Is it going to be worse? Some wells are going to end up being better. Some maybe not so good. So what you're trying to do is get to a place where you can get some high value and stay somewhat conservative. We may need to diversify depending on what happens with the first two assets. So this is how you get the math to get to $1 billion in valuation. Okay, let's get in deeper into the value for how does that turn into something for me as an investor, for you as an investor. You reduce that tax burden. We talked about that. You can get 100% off over a 5-year period. Most of that comes in the first year. So most of that is between 75 and 85% of that will come in year one. So the reason you want to get in before 12/30 this year is because you want to be able to get that K1 with that deduction. Last year, we delivered an average of 81% to partners of tax deduction. We'll look at the math behind that, but that's actually, this is the part, guys. This is why y'all came. That is what you can, that's the first piece of value. That is the first part of actually paying yourself instead of paying the IRS. If you don't like paying taxes, which I don't, hey, look, I'm a citizen. I know that's part of the deal, but I don't need to pay more than, well, we all know what they're doing with our money. I'd rather put it back in my pocket and put it to work. And so, unlike real estate, the big difference there is, and Jay talked about this earlier, is you get to take that deduction against adjusted gross income. In real estate, you can only take that against passive income. That is a huge, important difference there. So again, you can take that against adjusted gross income. The second piece is monthly passive income. We're targeting a low average, a range, if you will, of 2,300. Look, oil and gas is volatile. So your monthly passive income, it looks like a roller coaster. Seriously, there's some really great highs and there's some sucky lows in some cases. So the idea is to put in the range, and that's what we believe is achievable in getting monthly passive income. And here's another tax benefit. The monthly passive income is not taxable as long as the partnership is delivering essentially a paper loss. And the way that works is you're actually becoming part of, and I kind of miss this. I can't even believe I did it. This is so important. You're actually not buying into a wellbore assignment like other oil and gas deals. You don't do that. You're actually buying in as a partner into the assets at large. So all the assets, you're a partner in this. You're getting value. The way you achieve value is because you've bought into the assets, you've bought into the partnership with purchasing your unit, which delivers value at scale that you can achieve. So you're not just getting, you can get tax write-offs. That does, by the way, not all tax write-offs are created equally. People talk about them all the time in oil and gas, but it takes a lot of effort and a lot of planning and execution to make sure that you can maximize the tax write-offs. Just because it's in the code doesn't mean that translates to an oil and gas operation. There's buying pipe, there's buying concrete, there's buying all the services, there's getting the well spud. All these things play into that and making sure you have all that in place. And I'm telling you right now, it is tough to get a rig, yet we have 3 rigs running right now with a 4th coming. So and I got to credit Chandler. Chandler, man, he kills it. The guy can drill. He's got the relationships. It's been amazing to watch him work, and investors are getting paid as a result. So monthly passive income, 2,300 to 3,500 is a 14 to 21% cash on cash. Some people like to look at that as an IRR. Bottom line is getting that return, and that feeds back into that ultimate return on invested capital. So the third piece is the multiple on exit, taking $200,000, which is the cost of a unit, and getting a 3.5x multiple on that, sometime in the range of The horizon is 3 to 5 years. There's a lot of variables that go into that, no doubt. And when you have conversations with your SVP, or you can ask in the question box, they could talk to you a little bit more about that, or we'll be able to answer those. But the time horizon is 3 to 5 years, and that return is $680K. So back to the tax. So, and I kind of spoiled this slide a little bit, but we'll get into the details. So we're looking at, if your investment is $200,000, your deduction factor is approximately 75%. In your K1, your year one deduction is $150,000. So if you've got a $400,000 income, you just knock that income before any other tax strategies down by $150,000. Amazing. So, and depending on your situation, everybody's situation is different, but you could have an estimated tax savings, which is actually money back in your pocket. It's something I've taken advantage of. Jay has, many others, many other partners. I mean, we've already raised almost $17 million in this fund. And so there's other people that are excited about getting their K1s and being able to apply that to their adjusted gross income. But you could have anywhere 67, some people more, right? Depends on how much you want to invest. So, and again, I can't stress enough the importance of paying yourself instead of paying the IRS. Not only are you getting the deduction, but you're putting your money to work for you as an investment so that you can actually get yourself return of capital and then actually get a multiple beyond that. So MPI, that's the monthly passive income. It qualifies as a partnership distribution. That actually, again, as long as the partnership is generating a taxable loss at year end, you are not taxed on those. They're not eligible for taxes, those monthly passive income. Of course, I'm going to throw the asterisk in here, talk to your CPA, your tax professional for professional advice. I'm not a tax advisor. I do not have that license. Make sure you talk to them. If you have questions specifically, we've got a former IRS agent and all around freaking beautiful mind is how I talk about him. But anyway, he is eminently qualified to talk to you about taxes informally, I would add. So he is not licensed either, but he is very bright about this topic. So we can set that up for those of you who are considering very large investments for sure. So again, great opportunity. That usually lasts for a couple of years, that MPI qualifying for not being a tax. It depends. It depends on how quick we can deploy capital, how long the loss would carry as far as years go, but it could be anywhere from 18 to 24 months in most cases. So, okay. So we talked about the tax. That's a value quotient number one, or piece one. Second, I know there's a lot of words on here. Just focus on the middle. Okay. The dollar bill and the sign. This is how value gets achieved by pulling money out of the ground. All those hydrocarbons that we drill for, we sell them. This is how a dollar bill gets divided up and how we as investors get to participate. So first, as that dollar is achieved for selling a hydrocarbon, either oil or natural gas, royalty owners are paid first, then lease operating expenses, and then partners get to participate. So to get to return of initial capital, investors get 80%. So King gets 20%. So until you get 100% of money return, and this is, Jay likes to refer to this as ADD squared. So this being the first part of acquire, develop, and divest is to give you a fast track to getting your return of initial capital back. So on the monthly passive income, investors get 80%, King gets 20. Why does King get any? Because you want a healthy partner as part of this business. You want to make sure that we are aligned with incentives. That's good. After you get your return of initial capital, that split goes to 60-40. I'll show you what that looks like as we frame that out through the course of a full exit. So we'll look at that here, I think on the next slide, but that's how a dollar bill is divided up. The priority for profits is to get you your original capital, your original invested capital back to you as quickly as possible. And we do that through a couple of ways, and there's a fun little surprise on that. So, okay, this is the waterfall. For those of you that invested in alternatives before, you can kind of understand what this looks like. This is a scenario that we're looking at if we're able to get to an exit, right? So start up on the left. Don't cheat ahead. Everybody stay up on the left. Okay, good. All right. Your eyes are on the left, right? Okay. So we're looking at an exit. So an exit value of $1 billion, which is the goal, right? Total units being sold 1,000. So the per unit value is $1 million, right? This is on a $200,000 investment. Sorry, I wanted to put that out front. $200,000 investment to break even. So you as an investor, what's the break even? This does not include tax. So you can set your tax value aside, which gives you a great head start, but we set that aside for this purpose. NPI distributions are paid at 80%. So they count towards your return of capital, right? So NPI distributions are made at 80%. The first of multiple divestitures comes and you get 100% of that. So in this example, the breakdown would be a delivery of $150,000 to basically close the loop. You get 100% of that. So King is not participating in the divestiture value until you actually get your originally invested capital back. So that brings you in the break-even model. So we do a split of 80-20 on the monthly passive income, but when that first divestiture arrives, you get 100% of whatever that is. That's what we call an accelerant. Okay, that's the accelerant that gets you back to your invested capital. And now what we have is the next stage. Whoops, sorry, I jumped ahead. So how do we get to the multiple? Well, after the return of initial invested capital, you have the balance of those NPI distributions and any divestiture distributions. They're shared at 60-40. So this is a de-risk strategy in the economic model, gets you as much as your money, get all of your money returned to you as quickly as possible, and then deliver on the multiple. And that comes through, again, both NPI distributions and divestitures. That split goes to 60-40. We have even more incentive now in order to exit the program for all of us. And that's where you get your total return of a 3.5x multiple. You add your $200,000 return of initial investment, and then the after return of initial investment is 502 in this model. So you get a 702. I had the wrong math over here. My bad. I just didn't get that far. I undersold this, but 680 is not the right number. 702 is in fact the right number. So I know that might have created a little bit of confusion, but it is 3.5x when you look at the actual math there. So that's the waterfall path to getting return of capital and then the multiple. So that's ADD squared that Jay likes to talk about. I love that. It's let's get first thing first done and then build on that to deliver that multiple. And man, do we have an incentive to do that with you as partners. So that's the value. Does this happen in the marketplace? That's a question we get a lot. Yes, it does. There is a multiple on exit in comps. I get an email at least once a week, often twice a week, about divestitures for hundreds of millions of dollars. These things are going on all the time. We even have exit level value where hundreds of millions in the high level, or even into $1 billion and more. They happen all the time. And so we're obviously in the industry, so we see this all the time. We know what those news journals in the industry are telling us, but these are amazing opportunities. Again, weekly, there are literally dozens of these happen every quarter. So that's an exciting thing just to know, hey, this stuff actually does happen in the marketplace. Okay, what's the track record? So we're getting close on time here. So we're at the hour here, and we're going to do Q&A. If you guys want to stay, you can. But we're really coming to the end here. So have we done this before? Jay talked about it. Yes, we actually delivered. He talked about 131%. That was what the math ended up, because the partners decided to take the bulk of the divestiture value and reinvest it in more oil and gas wells. But the pilot program actually delivered a 3x multiple in 14 months. It was an amazing story, a great story. You know what? Track records aren't always pretty. We're not perfect. We had some tough lessons. We had some things that we couldn't control. We had some regulatory obstacles that we couldn't foresee, didn't foresee. And then we had the pandemic in that second program, which is Larimer County. We had some hard lessons there, and it was very difficult. The pandemic was, man, it was tough. I don't know if you guys remember, but oil dropped to negative like $29 a barrel for a few hours that day. People couldn't give it away. And so while that didn't last, the effects to the oil and gas industry were crippling for a lot of people. Well, what did Jay do? And this is one of the things I love about this guy. He said, forget it. I'm not giving up on my investors. And by the way, he wasn't giving up on himself either. He had his own money invested in this. He decided to grandfather those assets and expand to de-risk this program and bring his investors along. He bought additional PDP and started this program 3, which is an amazing story. He didn't give up on his investors. He could have, there was no rule or law against, hey, investments sometimes don't work out. He brought them along. And then not only did he do that, but when he bought the PDP, which is producing, right? Proven, developed, producing, right? So producing oil and gas hydrocarbons for sale that produced revenue, he shared in that from the first month. The first month that occurred, investors were part of that payment. It was a tough time. It was difficult, but investors were in. Jay was in. He made it happen for them in this program 3. And what I can tell you right now is the MPI forecast went 6 months in a row. It was beat 6 months in a row. 18% ROI as of November, meaning 18% return on originally invested capital. We're just getting started over there. We're in the middle of drilling, like I said, 12 more wells. Some of you on this call might actually be investors. I don't know, but it's been a great story so far. I had a small, kind of a surprise divestiture. That wasn't our plan, but we like to be able to sell things for premium value. And that was an opportunity for the partners. So now you see on the right-hand side, we're in program 4. So definitely a track record worth considering as you think about this investment. This is an eye chart. I'll just show you the details of, and this is available to you if you want to talk to your SVP or get involved with somebody. I'm not going to spend a lot of time because we're out of time, but I wanted you to at least see the details around that 3X divestiture and what happened with the equity raise, the sale proceeds, and then what was done with that. Again, only some of the money was returned back. It was such a quick win that the investor partners wanted to keep the money at work. So, and this is so far the story that we're telling, that we're living on program 3, which is a 3.5X forecast also. So again, you guys can look at more of these details if you have some follow-up, but just wanted to see that. And lastly, as we close, I do want to talk about the team. You know enough about me and Jay, but we got a great group of folks here. I did mention Paul Jerome, the SVP of Geoscience, a huge key to this. Chandler, can't say enough good things about. Chandler's drilled over 200 wells. Paul Jerome, been a geologist on over 400 wells, I think. These guys know what they're doing. It's amazing to have the right team. You got to have the right team. You can put together economic models all you want, but if you can't have people that turn the bit right the right way, you're in trouble. Garrett, man, I got to throw out Garrett out there. He's this amazing petroleum engineer, just joined the team, and I feel smarter being around him already. He's done a lot of good work for us. Michael Tanner, our Director of Finance and Analytics. Rex Gifford, EVP of Investor Relations. He's the former IRS agent, tax expert on our team. Eric Rice, our Chief Growth Officer. Nathan, our Chief Legal Officer. And of course, John Malden, some of you may know him. He's our Chief Economist. And then Graham Patterson, who's our strategist around. He's our CFO, but he's brought great value to the team around strategy to stimulate value with assets. So that's huge. What's the situation? Well, there is a clock on this, as you can imagine. Get in before this tax clock strikes midnight is how that is headlined. But the wire deadline is Friday, December 30th. Takes a little bit of time to put your paperwork together. You got to be an accredited investor. Accredited investors are the only people that can participate in this. That means you have to have $1 million in net worth outside of your primary residence, or $200,000 in income for 2 years in a row with an expectation of the same in the current year. So if you're that, go to kingoperating.com and you can connect with somebody. If you have a senior vice president who invited you to this, connect with that person to talk to them about this and make sure that you're available for conversation. They can walk you through any of these kind of details, but it takes a little bit of time to get your subdocs in. So don't wait until the 29th. You should be working through this. The holidays are right on us. So if you're liquid and ready to go, even if you have questions, let's get those answered as soon as possible. So thanks for your time. I know we've got probably some questions. So let me go. Man, this is great. We got 18 questions. Okay. So feel free to stay on. Again, we're gonna keep going. So I'll answer questions as long as you want to ask them. If you got stuff to do, I totally get that. If you're ready to go, hit up your SVP and make sure you guys get on with questions and so forth with that person. You can still go to kingoperating.com and get connected with somebody. There's a pop-up that shows up, ask you a few questions. You can get connected to an SVP that way if you'd like, but let's hit the questions. So, okay. Can you share the experience with the first fund that was for drilling in Colorado, how it performed and how you looked after investors' interest in the pandemic? I just answered that. So we'll go ahead and call that what it is. We just answered that one. So great question. Thank you, Suvi, for that. Cyrus, how will the oil business be affected by the current administration's infrastructure plan, which is focusing on environmentally friendly energy solutions, being funded to the detriment of new oil search lease opportunities? So we don't really get affected by the federal lease issues at all. We do have some areas up in the Bighorn that we have some lease space on the Bureau of Land Management. And so that's one thing that's a little bit of our area, but everything is super solid up there. We don't have any issues with those guys at all. It's politics, Cyrus. That's all I can tell you. I mean, he can talk about this. I mean, to be honest with you, all Joe Biden's policies do is make us money. He doesn't. He uses politics, and you don't have to. This isn't being on politics, and this isn't a political situation. It's policy. His policy makes King operating. It creates opportunity for King operating and King investors because we play inside the margins. And the bottom line is demand is up. It will continue to be up. Doesn't matter whether you're a Democrat or you're a Republican or you're an independent or you're a libertarian. It doesn't matter. These glasses, my jacket, this window behind me, the computer, the cars we drive, the batteries we use. Do you know that it takes more than 800 barrels of oil to produce one Tesla? And the eco footprint on a Tesla is the same, or in some studies worse than a combustion engine vehicle. So look, oil and gas is going nowhere. The demand is there. The specific policies that this administration has chosen has created opportunity for King operating and King partners. So great question. Appreciate that. DeBoles, I hope that's right. Are you going to get Larimer County going? If so, when? Larimer's not part of this project, so it's part of the other fund. So we are getting it going. Actually, we just completed 3D seismic finally. We've actually made great gains there, but again, it's not part of this project. So thanks for asking. Appreciate that. Please share the link to download the PDF document. Okay, so one more time. Hey, Cole, can you throw that in the chat somewhere? Kingoperating.com. He's typing the answer. That a boy. Cole's got it. Kingoperating.com/learn. That's where you can get the PDF version. Is there any carryover if you can't use the entire amount in year one? I think, Benny, you're talking about the tax benefit. Yeah, so the way it works is to get the 100%, you get 75 to 85%, which are based on intangible drilling costs. You get that benefit in the first year. And then in years 2 through 5, you get the other benefits, which are staged out over those years. The one thing I will say is you're required to declare how you want to do it. You can actually stage them evenly. Your write-off value, you can stage it evenly over 5 years if you like. But once you declare, that's your option. There's no takebacks. Okay. So good question. Thank you, Benny. Appreciate that. Well done. Scott Blaine. If I don't need the IDC deduction on the tangible cost deduction in 2022, I just answered that one as well. You can carry it across 5 years. That's up to you. Hopefully that is something that will meet your needs, Scott. Thanks for the question. Good one. George Saxey or Sassy, I'm not sure. So George, when are we going to see a turnaround in the investors' monthly passive income? When do you expect the investors to get their investment return? I answered that already. You can look more on, and I think you're talking about fund one. So look, as we've talked about all along, we've had some special divestitures. We had that pricing return that delivered extra value. We also had a divestiture as well. So if you have been part of that, George, hopefully you've been getting your distributions appropriately. And the timeline on that, we're still targeting into Q1, beginning of Q2, somewhere around June or July at the target timeline as far as when that would come back to you. And monthly passive income, man, the wells are already starting to return value back this month. We just started getting returns on the vertical program. So good question. Hang in there, man. It's part of the process, and it's coming. So Todd, 2 questions. One, I see in the materials reference to a 20 million insurance policy to protect GPs. Seems like a bad issue with oil could result in way more liability than 20 million. Can you speak to why you feel that's enough? Sounds like there was a dilution of Fund 1 investor positions. Can that happen here as well? What would be the circumstances? Okay, so let me ask the first one. Todd, good questions. Thank you. Excellent stuff. So on question number 1, I see the materials reference 20. Look, we've never actually had a liability loss at King. I'm not saying it can't happen. I'm not saying, if we're in business long enough, it may happen. We're not the only ones that carry liability. So could something be worse? We have environmental insurance as well, but the difference is we have, and this is how the oil and gas business work. There's contractors out in the field, for example, our frac contractor or our drilling contractor or our mud contractor. These contractors have their own insurance as well. So it's not just King. We have requirements of them up to $50 million for those larger contractors. So it's honestly not that big of an issue. Drilling inland is safe. There's been very little liability activity in the years, particularly in Texas. And it's public information. You don't have to take my word for it. You can go Google that. It's just not a big problem in the industry. And it's the risk quotient compared to offshore drilling is night and day. So good question. Sounds like there was a dilution of funds. Yeah, so we continue to raise funds and investors were diluted temporarily. We actually, for those investors, we actually filled that gap with a price increase from new investors. So it was minimal dilution if you look at the actual value return against what we originally forecast. I'm not saying it didn't happen. I'm saying that we addressed it before we actually added raise. And why did we do that? We did that to accelerate value. Now it takes time to drill wells. It's not like, hey, we get monthly passive income because, we could turn around in 30 days and do that. I mean, it takes months to drill wells. And so we've all along been forecasting a hockey stick in Q1, and we still look to hockey stick in Q1. That money is already starting to come in from those new wells. So great question. Hang in there. Would that be the circumstance in this one? I don't think so. And I'll tell you why, because one of the strategies that we did or that we deployed in this particular fund really came around making sure that we had more clarity on the lessons learned, if you will, in the last 2 programs, where we could focus on having a proper goal at the outset of $200 million raise. So that enabled us to basically see the whole pie better, more effectively. It also helped us position the acquisition strategy in a staged way so that we could make sure that we invested wisely as we went along, which we always do, but you learn lessons about how to actually accomplish that. But to take advantage of the bigger pie with a bigger target without having to sort of move the goalpost because opportunity presented itself like we did in the last fund. Now, there's always a return of value on that, but it does create short-term discomfort in monthly passive income. You still get your tax benefit. That's a great thing. And you can even get more tax benefit as well if you continue to reinvest. But bottom line is I don't see that. It's always possible. I will say that, but that's one thing that we really evaluated and answered to say, no, we're going to get the right goal out of the gate, take advantage of the value. Wow, the ratios of oil to natural gas are significantly different. Benny, I'm not sure if I'm answering a question. I think you're just making a comment. Thank you for sharing. So Sunil, I hope I said that name right, but thanks for your question. What are the chances that the oil well comes up dry or with limited oil? What is the percent risk for that? So flatly, there is no standard percentage. It's different in every field, in every basin. The geology is different. There are so many variables in oil and gas drilling, but we mitigate that risk by the strategy that we talked about earlier, which is when you think about making sure that you have good data, that we use 3D seismic wherever possible, which is very expensive. It's a huge investment, but make sure we have 3D seismic wherever possible, which, by the way, we have 3D seismic on both these assets. So the Rhino project and the Believers project both have really good 3D seismic data, which is, and they also have analogous production around them. So we know that there's wells nearby that are producing out of these same formations that are just underdeveloped, meaning there's a whole lot more under the ground than we currently have. So the risk is pretty low that we get a dry hole, but it's not impossible. So when I say pretty low, if I put a percentage on it, it would probably be wrong. What I can tell you is like I said earlier, of 40 plus wells drilled, we've had one dry hole, and sometimes it happens. The good news is, and this is sort of the advance in technology, most of the time now when you drill a well, you're going to find out if you have a dry hole when you're in the drilling stage. So you're not in most cases going to, you're not going to continue to pour bad money after good money. You're going to know by the logs that we run. So we analyze what we call shows in hydrocarbons as we drill the initial well, and that tells us in the formation. So, you know, if a budget costs $7 million to drill a well, we're not going to be all the way 7 million in and go, oh, dry hole. So that's one of the mitigation strategies that are in place now. So good. I love that question about that. The other part, don't forget about the risk mitigation strategy of geology. It's not just the geography, it's having multiple areas of focus. So is this type of oil, Benny, is this the type of oil that can be refined in US facilities, or does it need to? No, it doesn't need to go overseas. Good question. No, it stays here. Your model is based on $80 oil and $6 natural gas. Today's range is 70, it's 77 right now, but 75 and 6. When oil goes down, gas goes up. Actually, not always. That is common though. Absolutely great point. If this continues where oil goes down and gas goes up, would the projected returns be the same? The projected returns are always a variable. I will tell you that's why it's a projection. The one thing, this is different than real estate. Real estate has a lot more fixed components to it than oil and gas. Oil and gas it's volatile, gang. I'm just telling you right now, it's exciting. It's awesome when it's high, when it gets really low. But here's the thing. It's profitable. That's the question. It's profitable by two reasons. One is price is not that big a deal. Now, I'm not saying it doesn't matter. It's a big deal when it's amplifying your profits, right? But price is an amplifier. Quantity is more important. You want lots of wells producing a lot of oil and gas, and you want to do that as low cost as you can so that you can obviously get that profit. But the important part first is to get quantity. The second part is to remember that $60 oil is good. Okay. I like 70 better. 75 is awesome. I love 80, 90. We're not going to live in a world where $130 oil, which happened earlier this year, is going to be the mainstay, in my opinion. But I don't have a crystal ball. Big fan of Jesus. I know where I'm going when I die because he saved me from my sins. When he died on the cross, that I know. I know that there's evidence to that. 500 people saw him after he came out of the grave and witnessed his life as a resurrection. I know that. Okay, that I know, but I don't know about oil and gas prices being up or down. I just can tell you they're going to be up and down. I don't know what that number is, but I know we can profit in the 60s. I know we can profit in the 70s really well. And it's even better profit when you have the quantity, having 18, 20 wells online. So great question. Okay. K1 is passive loss. How can this offset? Sridhar, I hope I said that. Man, I'm butchering the names. That's me. Anyway, K1 is passive loss. No, K1 is just a partnership form. Okay. I don't know the exact boxes on the K1, but a K1 is not just a passive loss. A K1 is the form that partnerships use to produce their return on the partnership. It's just a form. The passive loss comes from the type of investment and returns or lack thereof that come through the K1. So you talk to your, this isn't Pete Snell, like, I'm not an accountant, okay? You got a CPA, you can talk to him. It's a great question. Just to clarify, you can look it up online. You can Google this and find out as well. So Investopedia, I think it's Investopedia. Go there, they have great, oil and gas investing stuff. I love them. They're great. What's the minimum investment? $200,000 is the recommended investment. Talk to your SVP about what kind of options you may have there if you want to come in. So love to have you in, anonymous attendee. Thanks for the question. What was the raise in programs 2 and 3? So program 2 got folded into 3. It got up to about 6 million, and that was folded into 3, and the total raise on that mark was 82.5 million. Good question. For program 2, what was the return on investment? Did they receive anything until? No, they did not. I mean, dude, it was hard lessons. I would have put a track record up there, but they're just zeros. So I shouldn't say that. They actually got a tax benefit. So, but not much of one of that either. So it was not a good program. And Chris, it's a great question. I wish I had a better story for you there, but it's part of the story and it's part of oil and gas. And so we don't need to run from it. We need to learn from it. And we have, and appreciate the question. What is the minimum investment? Just to answer that, 200K is the mark. If you want to talk to an SVP about opportunity, you can do so. How much have you raised so far for program 4? I think we're at close to 17 million, somewhere in the 16s, 16 and a half, close to 17. So we're well on the way, and we're already spending the money. That's good. I should say investing the money in the ground. Is there any way possible that a non-accredited investor, man, I would love to do that, Kevin. There's just no way. It's not our decision. That's the government makes those choices, and we got to abide by that. So Manoj, hi Manoj, what is break-even oil price for operation to be successful? There's actually no such thing, even though some people will talk about it. There's no such thing as break-even oil price because there are too many variables on expenses. So I'll tell you that I get uncomfortable in the low 50s and I don't like the 40s at all. So here's the point that you need to understand though, that's sustained over time. So if we dipped into the 50s, would that be bad? No. If we dipped into the 40s, would that be bad? Not if we can see a sustained pullback up from that. So, and honestly, there's not an economist out there right now who sees that in our time horizon. So, good question. Mahendramani, man, I hope I got that right. Mahendramani. Okay. How the current high interest rate conditions will play in this investment return. That's a great question. It does play. It plays particularly, we have inflation that we're dealing with our suppliers and our contractors out there. I mean, they have increased costs, so their prices are up. We've seen substantial inflation over the last year, and that has definitely played a part in being able to keep budgets down. We've expanded our contingent. So how have we combated that? Well, we're doing more with them, so we are getting some benefit from that and in doing things in volume. We're also another thing that we're doing is we changed our AFE. AFE is just a budget. That's all it is for a well. And so we changed our model there to make contingency 12%. The industry standard is 7%. We're targeting 6%, meaning if we can keep the budget within 106% of what we casted out in the beginning, then we'll actually be able to take some of that money and reinvest it in and maybe another well or two. Don't bank on that. That's an ambitious goal, but right now we've put that 12% out there to protect against that. It does not materially affect in a large way the returns when you look at the lifetime of these kinds of opportunities. So how the current high interest, oh, we did that one. Okay. Anonymous, how is the interest rate surge impacting the investment? It does. I mean, I just answered that, but we take into account that, and we talked about how we do that actually within the budgeting and making sure we have a proper contingency. So there's probably more question you have around that. Not sure that fully answered that, but that's a more detailed question for an SVP to walk you through. So Venkata, Jetty, when, by what date does the tax statement get delivered? On or about March, somewhere in the March, mid-March, end of March range. We actually have third-party tax preparer do that. So good question. Can you talk about the risks involved in this investment? You asked us at 6:38, Venkata. I mean, there's a lot of risk in any investment, in this one in particular. I would say, sustained price depression in the 40s would be a risk. The geology being wrong is a risk, although that's been mitigated in a lot of ways. Those are some of the big ones. Demand. I don't see demand doing that. One of the things that's kind of mitigated against that, and it's hard for me to answer this because I'm, I don't, when I say it's hard for me to answer, demand continues to rise, and gang, the supply infrastructure just isn't there. Large companies, I went to an A&D conference about 6 weeks ago, and one of the largest publicly traded energy companies, oil and gas companies, you know what their growth plan is for the next 5 years? 0 to 5%. The big boys are just, they're acquiring things to boost up and fight the decline curve of a declining asset. And what they're doing is that's how they're actually doing that, because they're focused on profits for investors. So it's very interesting, but there are risks, and those are some of them. And again, if the geology is wrong, you drill a hole that's not productive. Sometimes water. We're really getting better at water, but sometimes if the water doesn't show right in the geology, that can be a problem. It's expensive to get water out and to move it out if you're not in a place to be prepared for that. So my business partner is buying buyer of WTI crude. Will King Operating engage him as an investor and also as a buyer? Yeah, Krishna, I mean, that's a conversation that can be had. I mean, it's up to, I'm not sure what the end game there is. If you're a buyer and I mean, we work through first purchasers, so I don't know that would actually play, to be honest. First purchasers are large organizations where we have big contracts. If he's a first purchaser that buys a lot, I mean, I'm sure there's a conversation that could be had, but let's focus on the investor side first. So good question. I hadn't had that one before. That was pretty good. Is this a recurring fund? So I'm not sure what that meaning is for you, Anonymous. So this fund does have an end. We're going to raise $200 million. It's going to produce recurring monthly passive income. Eventually, the plan is to exit. If we weren't able to get divestitures or an exit play, we'll run the fund out until it's commercially viable. So as long as it's producing income, that's the backup plan, if you will. Hopefully that answers your question. I'm not sure if it does. If it doesn't, send us a note via email. What is the track record of past funds? Kranthi, is it Kranthi? So a 3X on the pilot program, a 3X multiple was returned. It was a bust on that was program 1. Program 2 was a bust, but those folks were actually grandfathered in and carried into program 3, and program 3 is still in the process of delivering. There's a high promise for that. And we covered that in the past, but or on the deck. So that's forecast for a 3.5x multiple and 18% return of capital, not including the tax savings or tax return. So hopefully that gives you a good answer, but we continue to build track record. We're doing it right now. So when do you expect to close this fund to new investors? Whether we get to as soon as we get to $200 million. So we're not going to run it in perpetuity, but we are forecasting that to occur sometime in the second quarter, maybe in the third quarter, but that's it's in 2023 and it's 200 million. And based on our pipeline of investors, that looks very achievable at this time. And again, we're already, I mean, we just started and we're at almost 17 million. So thanks for the question. Josh, can investors 1031 exchange into future King funds? That is coming. It's not here yet. We're looking in end of first quarter to maybe beginning of second quarter to provide a 1031 vehicle for folks to bring their 1031 funds in, and also the divestiture value from program 3, or what we've also internally called fund 1, into this model if they want to reinvest it without taking the tax hit. Good question. So it's coming. Kevin, is there any way a non-accredited? No, I'm sorry, Kevin. Again, let's talk to your senator and your House of Representative people about that. They make that rule, not us. How much does it cost to drill per barrel all in? It totally depends, Kevin. It depends on the asset. It depends on the location, expenses to actually drill the well. I mean, there's so many variables. We actually don't track a per barrel cost. We don't look at the data that way. So sorry, that was probably a disappointing answer, but that's not the focus. So any downside to the model if the full raise comes in below 200? It just scales back. So you still get value in return. We just drill less wells, and you get less total return. So you can still achieve the multiple. We just have to make sure that we're investing, and that's where some of that risk can come in play. You want to make sure that you're expending your CapEx is tracking on a spend rate that is consistent with what you're doing in your raise, so that you don't get out over your skis. So there is a science and an art to that. That's a great question. Also, how should we think about relative treatment of people who get their funds in this year versus sometime next year? I am more used to multifamily where all investors enter on. Oh, I get it. That's up to you. Look, if you want the tax benefit against your adjusted gross income this year, then you need to get in this year, which you basically have not very many days left. So, so that's, I would, and if you're liquid and you can do that, if you want to come in next year, come in next year. It's basically an open fund that is growing and being operated. Remember, it's acquire, develop, and divest. And we raise funds as long as that's appropriate for actually developing out the plan and then returning value. So that's a good question, but come on in. If you're ready, let's go. The 800K divestiture that you mentioned in previous fund, what was it acquired for? Well, we divested approximately 11, I believe, legacy wells in our East Texas area to I believe it was Sabine. Anyway, to a third-party producer who had some need and interest in some of the projects they were doing, which made it worth paying a premium. So it was a very nice return for investors, something like 60+X, small number, but still a great multiple on that. Good question. Mark Marlowe, if we had another COVID sort of event, how is Fund 4 better prepared to sustain the period of economic shutdown than Fund 2 was? That is a great question. So if we had another COVID sort, like there's no, one of the things we're doing is hedging. So I think the best answer for that is like, there's no guarantees or promises. I was going to say that first, but I know you know that, Mark, but one of the ways that we've prepared to help us in the event of a large scale problem like the pandemic is just that. We do hedging. And so hedging is part of the economic strategy. Even if price is depressed, as long as they don't stay depressed for, quarter after quarter, we could survive for some time. I don't know how long. I haven't done an analysis on that because there are quite a bit of variables that go into that, and we haven't actually stepped into that yet. That kind of analysis. We need to get to a sustained, we need to get to a minimum raise into the, $50-70 million range in order to start considering that in reality. That's a great question though. So we will analyze that stuff, but I will tell you that we do hedge. We already hedge. So, and for those of you who don't know, hedging, it's basically betting against the risk in the marketplace so that you can get a return of value to protect investors' capital. That's the bottom line. So good question. When is the first distribution expected? March, April, could slide to May, depending on how quickly the drilling could go. But we're looking like we're already spudding the first well in the Believers project in the Permian Basin this month. So it will take approximately 35 to 40 days to see hydrocarbons come back, which is January. That puts you in the zone of March, April. We'll keep you posted on that. If that date slips, we'll let you know. We're very transparent around here. We tell you what happens and why, even if you don't like it. We don't like bad news either. Sometimes it's just disappointing news. Right now we got lots of good news. So things look pretty good. So Guadam, is it Guadam? Okay. Are there any weeks drilled and started producing oils? And if it has, what's current passive? There is no current passive income in this. Again, I think we just addressed that. It's scheduled to hit around March, April timeframe for passive income to begin. So take advantage of the tax benefits now. You can work on the monthly passive income in a few months. So there you go. How much are the GPs investing in this deal in terms of percentage? I think Karthikeyan, I hope I said that right. I think you're talking about us. So everybody actually in order to get the tax benefit. Hey, Cole, good. Cole's got that one. Okay. Yeah. So we're looking at actually $3 million, up to $3 million, maybe more. I'm coming in as part of that. And so Jay and I are both individually coming in. Obviously, King is invested as the operating partner, but that's what we're coming in as. We've already started making that investment. So good question. So I can't say we're going to be the biggest. We've had a lot of investors come in with large investments, and that's fantastic. So Guadam, are there any wells drilled and started producing oil? Nope, I already answered that. Not yet. What sort of tax benefits would an investor receive, an investor in Q1? So likely similar. So we're going to be drilling, expending capital all year. There's an opportunity to do that in Q1. Of course, I would rather see you get in sooner so we can get to drilling faster. The more money that comes in for CapEx, the better. We can take advantage of that more quickly, obviously. But if your liquidity has you positioned for Q1, you're going to get that 2023. It's going to be similar to 75 to 85% because we're spending CapEx money, investing CapEx money in drilling. So great question. Is there a specific date on which the investors are converted from GP to LP? There is not a specific date. That actually occurs once the CapEx, it's usually going to be somewhere around 18, 24 months. You're going to convert to LP when the partnership starts to return a profit as a partnership. So that's, and I think Rex can make sure you ask your SVP to check on that. If that's an important detail to you, Cole, maybe you can text Rex and real quick and ask him. I think that's right, but in any case, send that in via email or talk to your SVP about it just to be sure. But I believe that the trigger is that the partnership begins to achieve a profit, and at that point you get triggered into it. Oh, that is right. I am okay. Sorry, it took me a minute. Lots of details. The reason that's the trigger is because you're going to continue to get your tax write-offs. We need to continue to deliver that while the partnership is producing a loss. And so after that is done, after we can no longer do that because CapEx has been expended and the partnership's starting to produce a profit, that's when you go to an LP because it doesn't matter anymore. You need to be a GP to get that triggered. And we need that for the next group that comes in 2023 to also have that advantage. and then you'll be triggered over. So good question. Then Kata, man, questions. Love it. You guys are killing it. 62. I can't have answered 62 questions. And there's 73 of you still on. Crazy town. Love it. Are the risks different for GPs versus LPs? Yeah, I can talk about that. That's a good question. Yes, they are different in the sense that as a GP, technically you have liability of a general partner as opposed to a limited partner. That's what we have insurance for. We have not had in 26 years of operation, we have not had a GP have a liability issue. So I look at track record, and that's what I'd answer on that. Technically, the liability is different. I will tell you that there are some investors who've gone out and bought an insurance policy for liability for themselves that costs like $1,000 or something. I'm not an insurance agent. I'm not telling you that I know how that works in this scenario. I'm just telling you some of our partners have actually researched that, and they've gone out because they had some concerns around that for themselves, and they're just protecting themselves and their interests. That's a pretty cheap investment for getting coverage there. And again, I'd encourage you to talk to your insurance agent about that, but that has actually happened. So, and again, we've never seen a GP have a problem in this regard. So good question. I think I skipped one on accident. Sorry. How much of this fund success is contingent on the success of the first 3 wells? John, that's a good question. It depends. So what I would say is these first 3 wells matter, right? We have opportunity to drill some great locations. It's not the end. We have a pivot plan already in place. We have backup assets that we're actually have warmed in our pipeline. It's not the end of the world if the first 3 wells didn't produce, and the likelihood that all 3 of them would be duds is pretty low, meaning that we've done all the work that you can to mitigate the risk out. I would tell you that the pivot play is already in place. We still have, so the first 3 wells are at the moment scheduled for the Believers project, but when we look at Wyoming, that's already on schedule for middle of Q1. So you're, in essence, the backup plan is already in place. But then the backup plan is also in place with alternative asset and our ability to acquire quickly. So it's a good question. I don't think the fund success is fully dependent on those first 3 wells, but they're important. I'm not going to sit here and tell you, John, it's not important. It absolutely is important. We need to have good hits there. I'm expecting us to do that. God willing, we will. So when the distributions start, is there a wide variance each month, or are they relatively consistent? It's volatile, straight up. In the beginning, because of flush production, where all the oil's coming on, it's mostly up. But as new investors come on, you get more investors come in, you get dilution on that, right? That's just part of the program. Remember, that's all scope because you already have a $200 million target. But when you're giving distributions to fewer investors, you're going to have higher payouts early. An incentive for you to get in early, to be candid, if you value that. I'm not sure you would or not, but the important part is to remember it is going to be up and down. This is not it's not like real estate. So let's see. Mark, I think you mentioned 18 identified wells with 4 underway. Not 4, we're targeting 3 at the start. We've got other wells up in the Rhino project that are on the docket. They're in the plan for, we've already been buying materials and so forth. So we're on our way, but just a small correction there, but good on the details on the 18. We do have 18 that we've identified so far. So how much capital is needed to develop all those wells? $200 million. Straight up. Need $200 million to develop those. So how many sites are qualified for per month to be worth testing? So we're focused on, we actually have an asset field plan for each of the 2 assets. If and when we bring on a 3rd asset, that plan will already be underway as well, as far as like where you go. So if you're talking about drill pad sites, Right now, we're building 3 drill pad sites with a total, it's a total, what do you call it? Total location path of, I want to say 10 to 12 total PUD level locations. So proven undeveloped locations. So there are 3 pads for that. Good question. How many wells are you targeting and program for? Again, 18. So I hope we could get 20 out of that. If inflation can get under control, that would help us get slip an extra well or 2 in there. But that's the stretch goal. So 18 is the target. If one had to invest 200 this year in 2022, and they still get a 75% tax write-off, is it confirmed or depends on no? So the percentage does not, how much of your adjusted or how much goes to your adjusted gross income is not dependent on your tax bracket. So that's dependent on how the fund, the partnership, deploys capital. So the deployment of capital is what determines the amount of your investment that is worthy of write-off, or qualified, I should say. It's all worthy. Is qualified for write-off. So that's a great question. Thank you. Venkata, what was the longest duration any of your funds took end to end? In this program, the pilot program was, in this model, I should say, the pilot program was 14 months, which was really fast. I would not expect that in this program. It's not realistic. So, and then the second or the third program, again, the second program, we talked about that grandfathering in. The third program is, June, April 2021. So we're getting into the 18-month range right now, and we're targeting an exit in 3 to 5 years. So we're on path right now, on track, on plan. For the first 3 wells, roughly, when do you realize, confirm if they're good, profitable? We'll know. Look, there's a lot that can change, and those first 90, 120 days are really pivotal because that's when you have flush production. But we know pretty quick, like we can get excited about log shows when you're looking at hydrocarbons in there. When we're actually looking after we drill, and we haven't completed yet, we haven't put in casing. Actually, you can do log wells even inside casing, but you like to get it straight into the mud. So we actually look at what are the shows. There's a way there's tools you stick down in there, and you kind of learn, hey, what do we have for, and we actually can do that while drilling. Anyway, there's a lot of cool technology, but we'll know if we have pretty good promising stuff early in the stage, and we'll know if it's not going to be good. Sometimes you don't really know until flowback. So when you actually go into frac wells, you have to pump a bunch of sand and water and chemicals down in there. And what that does, it's like, think about hitting a baseball bat on a windshield. It breaks the formation out to make it more porous so you can get the hydrocarbons out of it. Well, you got to cram all this stuff down into the wellbore, and then you got to get it back out, which is called flowback. So a lot of times when we see gas shows early in flowback, that's a good sign. So from a timeline, hopefully that wasn't too much OG talk for you guys, but from a timeline standpoint, we know as soon as, the end of the, we know as soon as the drilling's up, if we're having promising future, how promising, we don't always know that. But really after flowback is when you really know, and that's usually, 45 days or so after a well, depending on how big the well is. Some of these monster 2-mile laterals, man, they can take a couple months in some cases. That's not what we're drilling in the Believers project. These are 2 miles that actually don't require a frac because the pay zone is so porous already. So good question. Hopefully that wasn't too much detail there for you. Venkata, do you have customers waiting for you to develop so they can buy? Or do you have long-term contracts with your customers who buy the wells assets? Oh, I got you. Okay. So on the divestiture side, I think is what you're talking about. So no, there's nobody like waiting per se, but we have relationships. Yes, we have relationships. We have conversations with people all the time about what we're doing. I mean, that's honestly like half of Jay's job is being in the space, talking to other oil men, talking to other oil companies, talking to income buyers and so forth. He spends a lot of time developing that particular area of things to get us in position for a good divestiture. So good question. Okay, no more questions. Man, we've gone pretty long here. So you guys have been awesome. Still have 60 people on. Again, get with your SVP if you have one, and they can talk to you about getting into this fund, answer any questions. If you don't have an SVP, a senior vice president, you can barter for yours. Just kidding. But you can get one by going to kingoperating.com and fill out the form or hit the contact button. So thanks everybody for coming on board. Glad to have those folks who've already invested with us, and great questions today. Y'all have a merry and blessed Christmas and Happy New Year. Take care.